Ladies and gentlemen, we have an absolutely outrageous story that has just come out. Can you believe it? Taxpayers right now, you and me, are going to be forced to bail out central banks that made huge losses on their bond portfolios that they brought when interest rates were at zero. And you know what's the craziest thing about this? These central banks at the same time can print money out of thin air, but no, they're going to force you, the taxpayer, that's already struggling because of inflation, struggling because of them devaluing your currency, struggling from them lifting interest rates, and what's going to come next, they will make you lose your job in order to bring down inflation. And on top of that, guess what? You're going to cover the tab as well. People, this is outrageous, and we also have a major central bank underwater, and we've got some new news from the Reserve Bank of Australia. They've gone full economic forum. So everyone, how exactly are taxpayers going to be forced about these central banks, and what exactly caused these huge losses on their balance sheets? Well, that's exactly what we're going to cover in today's video. So let's not waste any time, ladies and gentlemen. Let's get straight into the news, the facts, and the data. Well, look at this, everyone. The Bank of England is facing major losses on its bond purchases and is set to get much worse. Now, while I'm going to be talking about the Bank of England here, the same thing is going to happen in the US. The Federal Reserve is facing huge losses from their bond purchases, so the US Treasury is going to have to bail out the Federal Reserve. And same thing in Australia, the RBA is going to have big losses on their balance sheet, so the Treasury is going to have to bail out the RBA as well. So listen to this, everyone. The Bank of England's losses on bonds brought to shore up the UK economy after the financial crisis will be materially higher than projected until the middle of the decade, according to Deutsche Bank. And listen to this. This is exactly how taxpayers are going to pay for this, which is completely outrageous. In late July, the central bank estimated that it would require the UK Treasury to backstop 150 billion pounds, that's $189 billion of losses on its asset purchase facility, APF. The program ran from 2009 to 2022 and was designed to improve financing conditions for companies hit by the 2008 financial crisis. It saw the Bank of England acquire 895 billion pounds worth of bond holdings while interest rates were historically low. So they brought nearly $900 billion worth of bonds when interest rates were at all-time lows. So what could possibly go wrong, everyone? Well, interest rates could go up and those bonds could absolutely crash, which is happening now. So the central bank began unwinding that position late last year, initially through halting reinvestments of maturing assets, and then by actively selling the bonds at a projected pace of 80 billion pounds per year from October 2022. Both the Treasury and the Bank of England knew when the AFP was implemented that its early profits of 123 billion as of September last year will become losses as interest rates rose. However, they severely underestimated how big those losses are going to be. The pace at which the central bank has had to tighten monetary policy in a bid to tame inflation mean the costs have risen more sharply than anticipated. Higher rates have driven down the value of purchased government bonds, known as gilts, just as the Bank of England began selling them at a loss. And guess what, people? The Bank of England isn't done lifting interest rates, so these losses are only going to get bigger and larger. But you know what's even worse, everyone? The Bank of England hasn't even hit peak interest rates yet. They're going to continue lifting interest rates even more, so these losses are only going to grow, meaning taxpayers are going to have to foot an even bigger bill. July's public finance data showed that the Treasury transferred 14.3 billion over the month to the Bank of England to cover the losses on its quantitative easing program, 5.4 billion above the figure projected by Independent Office for Budget Responsibility, OBR, in March. So this is absolutely crazy, everyone. Right now, we have lots of people struggling from the cost of living. They're struggling because interest rates are going up. They're losing their homes. They're going to be losing their jobs. But hundreds of billions of dollars are going to be going to a central bank that can print money out of thin air. This is absolutely crazy. And what do you think about this? Let me know down below. Now, Deutsche Bank senior economist noted that a total 30 billion has so far moved from the Treasury to the central bank since September, and the indemnities are likely to continue to run well above the government's forecast for two reasons. First, interest rates have risen far above the level assumed in a fiscal watchdog spring forecast, and second, Gilt prices have fallen further, particularly in the longer end of the curve, resulting in further valuation losses as the bank actively unwinds the APF through active gilt sales, Raja explained in a research note Friday. Now, head of UK rate strategy at NatWest said the hit to public finances and therefore to the government's coffers is twofold. On one hand, QT, that's quantitative tightening, loses money because the Treasury takes the Bank of England's losses when gilts are sold at a lower price than paid. This was expected. The Bank of England bought bonds in a falling rate environment due to disinflation, while success was to be defined by reinflation and so higher rates, he said in a recent note. On the other hand, though, while QE gilts are not sold, the Bank of England pays a bank rate on the £900 billion reserves it created to buy them. The higher bank rate rises, the more costly this interest expense becomes. So this is a double-edged sword, everyone. And again, the same thing's happening at the Fed and the Reserve Bank of Australia. They have this massive balance sheet that they're losing a lot of money on the valuation of these bonds, but at the same time, they're paying much higher interest rates to banks from these bonds or these yields on these bonds, and this is causing losses from the valuation of the prices, and also they're underwater by having to pay these high interest costs. So this could throw a wrench in the government's ability to offer public spending or tax cutting pledges ahead of a general election slated for 2024. So that's right, everyone. There's going to be cuts in services, you're going to be taxed more, and it's all going to go to the big banks. What a great free market economy we live in, everybody. Said absolutely no one. So not only is inflation running higher than expected, the indemnity costs of the Bank of England's balance sheet operations will almost certainly be higher than what was expected only 5 months ago, adding that this additional weight on the government's debt servicing bill will be reflected in Finance Ministry Jeremy Hunt's autumn budget statement. So everyone, what this simply means is these central bankers, they printed money out of thin air. They brought these bonds crashed in price because interest rates went up. Investors don't want to buy bonds with paying lower interest rates. They want to buy the bonds that have a higher yield. And so they've faced huge losses on these bonds that they brought, and now they've got to pay a lot of interest on these bonds, so they're getting hit from all angles. And at the end of the day, who's going to pay this bill? That's right, you and me. This is absolutely insane, everyone. This is how the monetary system really works. You really need to open your eyes and realize how the banking system works, how these central bankers work. It's all funny money. It's all smoke and mirrors. Money is not real at all. It's just digits on a screen that's being transferred from balance sheet to balance sheet. They're just swapping these assets on these balance sheets. It's not real money, but at the same time, they're using this fake monopoly money to go out there and buy real goods, buy real hard assets, and also buy the most precious thing, your time and labor. So that's what's happening in the Bank of England. But there's something else I want to talk about in Australia, something crazy. You know how the economy is really deteriorating, interest rates are increasing, people are going to be losing their homes, hundreds of thousands of people are going to be forced to sell their homes in Australia. You think that the Reserve Bank of Australia would really want to address what's happening in the economy? The Reserve Bank of Australia has been a complete joke. They've only lifted interest rates to 4% when all other central banks have gone to 5 or 6%, and that's why Australia now has a much higher inflation rate than the US. We're seeing the Australian dollar completely tank. It's pretty much becoming the Pacific peso right now. And also we're having a huge housing crisis. You think some of this, you think some of these issues the new RBA governor would want to address, but no, her being the first female RBA governor, her biggest issue is not the economy, is not inflation, is not people losing their homes, is not the housing crisis, is not the cost of living crisis. Do you know what her biggest concern is right now? That's right, climate change. Look at this, everyone. This is absolutely insane that this is the top of her agenda right now. So look at this. Climate change will impact interest rates, incoming RBA boss says. Now, for all my friends around the world, you definitely need to pay attention to what happens in Australia, because we all know Australia is very praised by the World Economic Forum, and they're really a testing ground for a lot of things. Just look at the draconian lockdown measures we had during COVID. So if all of a sudden the RBA starts focusing on climate change, then maybe you see the Federal Reserve or the Bank of England may start to focus on that next. Now, this is absolutely crazy, because the central bank is just meant to focus on monetary policy, and that's it. How can they possibly make any changes to climate change? They can't do anything about it. all they do is print money. I guess they can stop printing paper money, which they've already done, and go digital. So I guess that kind of helps the environment. But they should not have any say in politics because the RBA is meant to be independent. Pretty much any central bank is meant to be independent when we all know they aren't. But let's dive deeper into this story, everyone. So the new Reserve Bank boss has warned that there is a new threat on the horizon that will have a major impact on the stability of the Australian economy. You may be thinking, okay, maybe she's going to talk about the cost of living, the housing crisis, inflation. No, climate change. The actions taken in response will have broad-ranging implications for the economy, the financial system, and society at large, he said in an address to the Australian National University in Canberra on Tuesday. The timing and intensity of its effects are uncertain, and these could be severe and irreversible if tipping points are reached, he said. Now, of course, we need to take care of the environment. Of course, we need to take care of the climate, but there's absolutely nothing the central bank can do about this besides increasing the ESG score. She said the bank expects climate change will impact the economy's capacity to produce goods and services and have flow-on effects on interest rates. It might also affect a neutral interest rate and therefore the stance on monetary policies, he said. So that's right, everyone. Could we get to a stage where they're going to say, look, climate change is, getting really bad, so we actually need to lower interest rates. Don't worry about inflation. That's not, our priority right now. Our priority is climate change. As the review of the Reserve Bank has helpfully reinforced, climate change will have implications for price stability, employment, and the stability of the financial system, she said. As such, it's worth discussing how the bank is considering the impact of climate change on our policy mandates. She said, hotter temperatures and more extreme weather will disrupt businesses, damage property, and lower productivity growth. However, she was adamant that actions to reduce emissions in a timely manner could reduce the economic burden of these changes. So I don't know if she's sounding much like a central bank governor or more like a politician here, everyone. What do you think? Let me know down below. Indeed, while there is much uncertainty in this area, there is general agreement that a timely and orderly transition will be less costly approach in the long run, she said. Now, I'm not going to pretend like I'm an expert on climate change, but what I can see here with this new governor, it seems like she's not addressing any of the real hard issues we're having today, and she's focusing more on political points. So everyone, I thought these two stories on what's happening with these two central banks were very, very important for you to hear. What do you think about these two stories? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.